Hello and welcome. Chapter number 2, Financial Management of Facility Organization. In this chapter, we will learn about the following topics. The topics are types of budget and budgeting concepts, financial statements, cost terms and cost accounting concept, cost containment, chargebacks, budgets and budgeting basics. Budget, a financial plan outlining expected revenue and expenses for a specific period. Budget serves as a guide for financial decision making and resource allocation. As part of facility management, there are two types of budgets: operating budget and capital budget. Operating budget covers day-to-day expenses required to run the facility, and capital budget focus on the long-term investments such as equipment or building improvement. Budgeting is the process of gathering financial information, making projections, and tracking progress towards those financial goals. Understanding and managing both operating and capital budgets are essential for facility managers to ensure smooth operations and plan for future use. Why budgeting is important? Budgeting is important for the financial control, resource allocation, performance measurement, and strategic planning. Budgeting is important for financial control by ensuring expenses remain within the planned limit, and resource allocation by helping prioritizing spendings on critical maintenance, operations, and capital projects. Performance measurement by tracking whether financial goals are met and identifies area of improvement. Strategic planning by supporting long-term objectives. A well-prepared budget is the backbone of effective financial management in any facility. This helps maintain control and ensure alignment with the organization's mission. Budgets approach. There are three main types of budgeting approach. The first one is authoritative. In this budgeting approach, top management create the budget and hand it down to the department. This is often used when quick decision making is required and senior management want to full control over financial decision. This is also known as top-down budget. Advantage of this budget is better control over budget and decisions. Disadvantage of this budget is this dictates instead of communication. Senior management may be out of touch of operations and may set unrealistic goals, which can result in the employee feeling unmotivated. Participative budget. In this budget, inputs are gathered from various level of organization, including managers, employees, and other stakeholders. This encourages collaboration and ownership, but this can be more time-consuming because everyone's input needs to be considered. This is also known as bottom-up or self-imposed budget. Advantage of this budget is expertise lead to informed budget decision, employee feel empowered, and disadvantage of this budget is a strategic goal don't receive priority in the budget process and might lead to higher cost. Combined budgeting. This budget is ideal process for the future of authoritative and participative budgeting and falls somewhere in between. This method, also known as iterative, senior management understand these participants' need and difficulties. Participants understand the management's difficulties and strategic planning. Advantage of this budget, strategic goals are communicated and implemented to the top down. Disadvantage of this budget is control retained and expertise gained at the cost of slightly longer process. An example of this budget is a company might set a broad capital budget for building upgrades but allow facility managers to propose a specific project cost and improvement within the framework. Budgeting assumption. These are the reasonable estimates which we make about future conditions to guide our financial planning. Regardless of a company's unique requirement or budgeting model, the budgeting process typically involves set of reasonable assumptions about the future. We can consider these budgeting assumptions such as what are the revenue expectations in upcoming year, what are the projected operations expenses, what projects are forecasted, how many full-time FM employee will be needed and how much will be compensated, how many contracted person will be required, are suppliers price expected to increase, how much will be the rent, tax or insurance. Discussion with the colleagues in different department are also valued activities such as we can discuss with the sales department about the tenant's performance, we can discuss this thing with the finance about the past performance and future trends. We can discuss with the purchasing about the suppliers and price trends. We can discuss with the suppliers and landlord about their opinion. Type of budgets. As part of facility management, there are two types of important budgets. First is operating budget and the second is capital budget. Operating budget. An operating budget is a short-term budget projecting all estimated income and expenses for a given time, generally for 1 year. Operating budget, also called as a operational cost or operational expenditure. Operating budget provide an important management planning and control mechanism. Capital budget. Capital budget. Capital budget focus on large investments such as major projects, renovation or purchase, and this is the financial plan for long-term investment in assets and infrastructure. This focus on high cost and durable items like buildings, equipment, and technology upgrades. This ensures strategic allocation of resources to support organizations' goal. Due diligence. Gaining approval for the capital expenditure can be challenging. A facility manager increases chances of approval by rigorous due diligence. So, what is the due diligence? It is the process of systematically evaluating a project's feasibility, risk, and benefits. Think of it as your safeguard to make informed decisions. Steps in the due diligence process are: does the project support organization's business objectives? Is the project providing the average ROI? Do's and don'ts of the project. Will the project modernize work process and result in the cost saving? Is this project necessary to compliance with the legal regulatory requirements? Does this project involve replacement of the worn out equipment? What are the financial risks associated with this project? Additional budgeting concept. Additional budgeting concepts are: the first one is expense projection. Expense projections should consider all the costs required to achieve the organization's objective, such as capex and general administrative cost. Upcoming changes and unknown must be factored, such as but not limited to increased personal cost and associated expenses, such as compensation, benefits, training, additional office space, additional supply and supervision. Next is rising administrative costs, such as rising insurance cost and rent and government fees. Next, seasonal variations such as increased cost of temporary labor, periodic maintenance, utility, etc. Number two is fixed or variable budgeting. Fixed costs. Fixed costs are the costs that remain unchanged in total for a given time period, despite wide changes in the related level of activities such as licensing fees or taxes. Variable cost. Variable costs are the costs that change in the proportion to the related level of activities such as fuel cost. Next is budget period. Organization must prepare a budget for a set time of period. A budget is typically established for 1 year of period. Annual budget generally further break down in half yearly and quarterly budgets, which allows managers to compare the actual budget with the budgeted data. This process can help manager to identify any problem in the budget and to take necessary actions more quickly. Budgeting method. In the facility management, trend budgeting can be used to manage finance effectively. Let's look at each with one example. So the first one is incremental budget. Incremental budgeting builds the new budget based on the previous year's budget with a small adjustment. For example, if last year operating budget was 500,000, so you might increase it by 5% to account for inflation, bringing the new budget to the new figure. This is a small straightforward adjustment to the previous year budget. Next is zero-based budgeting. Zero-based budgeting starts from scratch every year, justifying every expenses as if it's a new cost. For example, starting first, you would justify every expenses such as security, cleaning or maintenance as though you are building the budget from scratch. So for instance, you would need to explain why you need 100,000 for maintenance even if you spent it last year. Next is activity-based budget. Activity-based budget focus on budgeting for a specific activity or project that drive cost. For example, if you are planning a renovation project in the building, you would allocate specific funds to activities like construction, interior design, and equipment installation. Next is flexible budgeting. Flexible budgeting adjusts the budget based on the changes in the workload or performance. For example, if facilities uses increase like adding more tenants or increasing operational hour, you can adjust the budget for extra cleaning or maintenance maintenance services to reflect those changes in the workload. Guideline for effective facility management budgeting. Imagine a facility manager budgeting for a commercial office of building. Then he need to understand facility need. He need to review past budget. He need to prioritize key activities, separate fixed and variable cost, plan for emergencies, monitor and adjust, preventive maintenance, use of technology, includes sustainability, collaboration with the stakeholders. While preparing a budget, facility manager has to consider the contingency fund, at least 10% of the total budget for emergencies. Budget closeouts. What is budget closeouts? Budget closeouts is the process of reviewing and finalizing a facility's financial performance at the end of a budget cycle. This involves comparing actual expenses against the budgeted amount to justify and identify variances. This ensures accountability by closing any outstanding payments and preparing for future cycles. Financial statements. Financial statements portray the current financial health and financial history of an organization. An organization prepares the financial statement from the accounting records once it is confirmed that all the accounting data is accurate. All data presented in the financial statement should be clear, appropriate for the intended use, accurate, such as free from errors, complete, including all necessary information, consistent, and timely. For facility managers, understanding these statements is crucial for budgeting, cost control, and overall financial management. By reviewing accurate and timely financial data, you can make informed decisions about the operations and resource allocation. Financial statement categories. In the facility management, financial statements help track performance, allocate resources, and make informed decisions. These statements are categorized into three main types. So the first one is internal financial statements. These are created for internal use within the organization, often by the finance or accounting team. They provide detailed insights into day-to-day financial activities, helping facility managers make decisions quickly and manage the facility's operation efficiently. For example, a monthly income statement showing the operation cost of facility management tasks like maintenance, utilities. The next one is external financial statements. These statements are prepared for external stakeholders such as investors, regulators, and leaders. These statements provide a broader view of the company's financial health and are usually presented in standard format like balance sheet or income statement. For example, a facility's annual financial report that is shared with the investor to demonstrate profitability and stability, including detail of capital expenditure on property grades. Next is audited financial statements. These are the financial statements that have been reviewed and verified by an independent auditor to ensure accuracy and compliance with the accounting standards. Audited statements offer credibility and assurance to external stakeholders such as investors or regulatory bodies that the financial reports are accurate and trustworthy. Understanding the different types of financial statement is crucial for facility manager. Internal financial statement helps day-to-day decision making. External financial statement provide a clear view for outside stakeholders, and audited financial statements ensure transparency and accountability. In the facility management, understanding the different types of financial statement is essential for tracking the financial health of operations. So here are the key types. The first one is income statement. This is also known as profit and loss statement. It shows a company's revenue, expenses, and profit over a specific period. This helps facility manager assess whether the facility is operating profitably or causing a loss. Next is balance sheet. The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. This shows what the facility owns, such as assets, and owes, like liabilities. For example, a balance sheet showing the value of the facility's equipment, outstanding debt, such as loans for building improvement, and owner equity in the business. Next is statement of cash flow. This statement tracks the flow of cash in and out of the business, focusing on operating, investing, and financing activities. This is important for understanding the facility's liquidity to cover short-term obligations. For example, a statement that's showing coming in from the facility management contracts and the cash used for capital expenditure like purchasing new HVAC system. Next is a statement of shareholders' equity. This statement outlines changes in the company's equity over time, such as retained earnings, borrowing, stock issuance, or dividend paid. It shows how profits are being reinvested or distributed among the shareholders. For example, a statement showing how the facility's profit were reinvested into the property upgrade or paid out as a dividend to the shareholders. Each type of financial statements play a vital role in a facility management. The income statement tracks profitability, the balance sheet gives a snapshot of financial position, the cash flow statement shows liquidity, and the statement of shareholders' equity reflects the ownership structure. Notes to the financial statement. The notes to the financial statements provide additional detail and explanation to help stakeholders understand the numbers presented in the financial statements. These notes offer transparency and clarify how certain figures were calculated or what they represent. So why are notes are important? Notes clarify complex information, they explain complex financial data, making it easier to understand. Disclose accounting policies. Notes reveal the accounting method used, such as how assets are valued and how depreciation is calculated. They give context to significant financial transactions, such as large expenses or investment. They help ensure that financial statements are accurate and compliant with the accounting standards. For example, the facility is having a HVAC system which is depreciated using a straight line method over 10 years. Next example, lease and rental agreement. This provides detail about lease agreement like terms, payment schedule, and liabilities related to the leased property, such as the facility has a 5-year lease agreement for office space, annual rent payment of 100,000. And these kind of notes in the financial statements provide clarity and transparency to understand stakeholders' technical terms. They explain the numbers in financial statement and ensure transparency and accuracy in reporting. Capitalization versus expenses. So first we need to understand what is capitalization. Capitalization refer to recording a cost as an asset on the balance sheet rather than an expenses. The costs are typically for long-term investment that will benefit the facility for several years. For example, if a facility buys a new equipment or renovate a building, the cost is capitalized and treated as an asset because it will provide value over time. While the expenses are fully deducted from your budget or profit in the year they occur, affecting short-term financial performance. Expenses are costs that are incurred and recognized immediately in the income statement as they provide short-term benefits. Capitalization adds value to the long-term assets. Costs are depreciated over the useful life of the asset. It helps spread the cost over time. Lease or purchase consideration for capital assets. So first of all, we need to understand capital asset. A capital asset is a significant long-term asset owned by any company and used in its operation to generate value. The asset can be tangible or intangible, including buildings, equipment, land, vehicles, software, or any intellectual property. When acquiring capital asset, a facility manager must evaluate whether to lease or purchase. Each option has advantage and disadvantage depending on the organization's financial strategy, operational need, and long-term goals. So consideration to understand before acquiring any capital asset. The first one is cost comparison. Leasing typically has lower upfront costs but lead to higher overall expenses over time, while purchasing requires large initial investment but generally save money in the long run. Next is budget impact. Leasing spread cost across multiple years, making it easier to fit within the operational budgets, while purchasing impacts the capital budget significantly, but the asset becomes a long-term organizational resource. Next is flexibility. Leasing provides the flexibility to upgrade or replace asset as needed, especially for technology-prone items, while purchasing locks the organization into ownership, which may limit adaptability to changing needs. Next is maintenance responsibility. Leased assets generally include maintenance services within the agreement, while purchased assets require the organization to cover all maintenance and repairs, which can increase operational responsibility. Next is ownership and asset value. Purchasing builds equity, offering potential resale value and full control over the asset, while leasing does not result in ownership, which means no residual value after the lease ends. Pro forma statements are financial forecasts that help you plan for the future. They answer questions like what will happen if we install energy efficient lighting or can we afford to renovate this facility. There are some key concepts of pro forma statements. The first one is pro forma income statement. The pro forma income statements estimate your future revenue and expenses, for instance, upgrading your lighting might save 50,000 annually but require an upfront cost of 100,000. Next is pro forma balance sheet. The pro forma balance sheet shows the impact on your assets and liabilities, like adding the new lighting system as an asset. The next is pro forma cash flow statements. Pro forma cash flow statement ensure you will have the enough cash to cover the installation and operation. These statements help you make informed decisions and convince stakeholders by showing the long-term financial benefits. For example, if your pro forma shows that energy savings will cover the installation cost in next 2 years, this could be a smart decision. Pro forma statements are your financial crystal balls. Use them to plan better and secure approval for your project. They are used for what if scenario. Cash flow forecasting. Cash flow forecasting is about predicting the money flowing in and out of your facility. It ensures that you have enough cash for daily expenses and emergencies. Cash flow forecasting involves estimating the inflow and outflow of cash over a specific period. Cash flow are influenced by the collection of accounts receivable and accounts payable. Speeding up receivable and payable can affect the cash flow. Benchmarking. Benchmarking in facility management is the process of comparing your facility's performance, practices, or cost to industry standards, best practice, or similar facilities. It helps identify area of improvement. Type of benchmarking. Internal benchmarking. Internal benchmarking is the comparing performance between departments or facilities within the same organization. Next is external benchmarking. External benchmarking is for comparing performance with the other organization, industry standards. Next is functional benchmarking. Functional benchmarking is focusing on a specific process or function such as energy consumption or maintenance cost. Key benefits of benchmarking. First one is performance improvement. We can identify gaps and set achievable goals. Next is cost management. We can reveal inefficiencies and potential savings. Fundamental cost concept. Facility manager must understand fundamental cost concept to manage budgets and optimize operations efficiency. These concepts classify and track cost for better financial decision making. So what are the key concepts? So the first one is fixed cost. Fixed cost is that remain constant regardless of activity levels such as rent, salaries, and insurance premiums. Next is variable cost. Variable cost is that changed based on the level of activities or uses such as utility bills, repair cost, consumables, or repairing. Next is direct cost. Direct cost is directly related to a specific activity or project such as material for a renovation project. Next is indirect cost. Indirect cost is overhead cost not directly tied to a single activity but necessary for operations such as administrative expenses or facility wise utilities. And next is life cycle cost. Life cycle cost is the total cost of ownership over the asset's life, including acquisition, operation, maintenance, and disposal. For example, cost of HVAC system from a purchase to decommissioning. Cost management system helps facility managers to track, allocate, and control expenses. It ensures that resources are being used efficiently and costs are being properly accounted for. There are four key concepts of the system: cost identification, cost allocation, cost tracking and reporting, and cost control. Cost identification is the first step. This involves recognizing all costs related to the facilities operations such as maintenance, utility, cleaning, and staffing. Identifying these costs accurately helps to understand where the money is being spent. Next is cost allocation. Cost allocations assign these identified costs to specific department, projects, or areas within the facility. This ensures that each unit or business area is responsible for its fair share of the cost, helping with budgeting and cost transparency. Next is cost tracking and reporting. Cost tracking and reporting involves monitoring ongoing expenses, recording them in real time, and generating reports. This allows facility manager to stay on top of spending, identify potential cost overruns, and take action when needed. And the last one is cost control. Cost control ensures that expenses remain within budget. This is done by setting budget limits, enforcing spending guidelines, and finding ways to reduce cost where possible. Facility management metrics are key performance indicators. This is also called KPIs that help track the performance of the facilities, operations, and services. They give you measurable data on how well your facility is being managed and where improvements can be made. So here we have some general FM metrics. The first one is total occupancy cost per square meter or square foot. The next is total occupancy cost for total staff, total occupancy cost for FM staff, budget variance for total budget, and so on. And here we have some operating and maintenance FM metrics. The first one is total utility cost per square meter or square foot, and next is total utility cost per total staff. Next is operation and maintenance cost per square meter or per square foot. The next is operation and maintenance cost per total staff. Next topic is cost containment strategy. So what is cost containment strategies in facility management? These focus on managing and reducing expenses without compromising service quality. So what are the strategies? First one, supply chain consolidation. Supply chain consolidation can reduce administrative cost by measuring fewer suppliers and removing duplication in supply chain management. Next is leverage volume purchasing. While leverage volume purchasing, we can take advantage of bulk buying opportunities to get better pricing and reduce procurement cost. Next is multi-skilled staff. By having multi-skilled staff workforce, we can reduce overall staffing needs and better allocate resource. For peak times, peak time we can consider temporary staff. Next is subcontract services. We can outsource some services to eliminate markups and achieve cost saving. Next is service level reviews. Review on the services to understand facilities frequencies and adjust resources saving on material and labor cost. Next is zero based budgeting. We can use the zero based budgeting to start each budget period from scratch, justifying every expenses instead of using the previous year's budget as a baseline. And next is efficiency program and market testing, plant maintenance. We can focus on preventive maintenance rather than reactive maintenance to save cost and time. Then next is expenditure deferral. If it is possible and needed, we can delay some non-critical expenditure to the next budget period. Sell used equipment. Next is chargeback practices. We can use chargeback practices within the organization so that we can generate some revenue. Next is energy efficient investment. Cost containment involves managing and reducing expenses without sacrificing quality or services. For facility managers, it is about finding smart ways to maintain operations efficiently while keeping cost under control. So here we have some key guidelines for effective cost containment, such as institutionalize cost reduction, especially in decision making process, identify area with high cost containment potential and act on those first, minimize waste, mitigate fraudulent practices, generate specific saving ideas, develop methodology to track actual savings, and so on. Chargeback. So, what is chargeback? Chargeback, also known as cross charging or recharging, describe the ability of the facility management department to charge its services to another that is requesting for those services. In chargeback system, the facility management department charges other department for the services which they used, such as maintenance, cleaning, or utilities. This is typically done through an internal accounting process, ensuring that the costs are distributed fairly and transparently across the organization. Chargeback system is an effective way to manage cost and allocate expenses within a company. Chargeback system can vary, but facility management typically use one or more of following method. The first one is actual direct cost, which means only charging for the direct expenses incurred in the providing services, such as facility management can charge for the paint and material used. Next is charge actual direct cost plus overhead charges. In this case, for example, some cleaning services is provided, so the facility management can charge for the cleaning services plus some fixed overhead charges. Next is charge on allocation based on specific criteria. In this thing, distributing cost based on the specific criteria like square footage or department uses. So this is how chargeback system works. Facility manager's role in chargeback system. So as a facility manager, your job is to determine what cost to charge back and how to charge them and the basis for providing services. This includes assessing the actual operational costs such as maintenance, utility, and space uses, and determining which of these costs are allocated to a specific department or business. So as a facility manager, you need to ensure that what cost to charge back and on what basis to charge back and on what basis the services will be provided, or that actual operation cost is determined. You need to ensure that a standard method for defining and charging for the occupant and vacant spaces is determined and communicated to to all parties. You need to make sure business units understand the financial implications of facility related requests. You need to make sure the services to be charged back are adequately communicated and agreed by the customers. You need to make sure where appropriate and necessary service level agreement is established with the customer. Thank you. Congratulations, we have completed chapter number 2 for the finance and business. Hope this video was helpful. Good luck for your exam and happy learning. And if you have any suggestions and feedback on this video and course, please do comment below. We accept and welcome your comments and feedback. We are continuously working to improve our content and help you better. Thank you again.